Hina Shoeb, you are Director, Retail Media and Leisure at S&P Global Ratings. Thank you for joining us on BiTV.
Thank you for inviting me.
In its recently published analysis, S&P Global Ratings states that many European lodging companies could experience a slower post-pandemic recovery than was previously expected. What might be the main challenges hindering the post-pandemic recovery of the hospitality sector, and what could these imply for hotel operators like Accor or Hilton?
No, thanks. I think it's an excellent question. A lot of investors are asking us the same question because what happened was right after pandemic, especially the end of 21, we saw a sharp recovery because I think people were tired of, being inside, indoor, trapped. So everyone wanted to go out. So what we saw was there was a leisure pent-up demand. People wanted to go out for vacations, so and so forth. So we saw a sharp recovery. What worries us is more, I would say, not about 22, but more, let's say 2023. And I could give you 3 or 4 big main reasons, which is what could jeopardize the recovery that we are seeing. So of course, we are expecting good summer for 22. That's a given. That's already included in the base case. But what's worrying is the macroeconomic and geopolitical uncertainty that could jeopardize international travel. And I think when we are in Europe, we could appreciate that the war zone is probably far away, but someone coming in from the US or from Australia, they might want to just not come to Europe altogether. I mean, they might want to go to, I don't know, to Africa or to Asia or to some place completely far away. So there is going to be, we think, an indirect impact because of the Russian-Ukraine conflict. Plus, if you look at the overall situation, we have supply chain issues, we have inflationary pressures. A hike in fuel costs means that at the end of the day, we're all going to be paying more for our international trips. So that makes a lot of things on the macroeconomic front much difficult in 23. And also think of this way, that people have done a lot of trips or are expected to do a lot of trips in 22, then maybe 23 is when you'd have inflationary pressure, you would have dampening of consumer confidence that could have an impact. And I think the third important element which we shouldn't forget is right now we're all in this hybrid working mode. I'm working from home most of the time, so there is going to be an impact on business travel, and that business travel is not recovering especially in Europe back to 2019 levels. So we could argue that based on a lot of these factors, it will have an impact on 2023. Now, having said that, I don't want to give a blanket statement because it all depends on price segments, the hotels where people are in, and also the cash flow model of the hotel itself. So if you're, let's say, you are a hotel owner, you are subject to greater volatility than a franchisor purely because of the cost structure. And the fourth point, which is last and most important one, that financial policy decisions made by the companies will really have an impact or will weigh heavily on the ratings. So those are the top 4 reasons for 23 and onwards.
Thank you. Businessimo, our readers and listeners are a lot of them are invested and active on the real estate side. So I have to ask, how might these trends affect the hospitality investment market and the property companies that specialize in this asset class?
Yeah, frankly, this is a very difficult question, but at least I'll share you what the house view is on the sector. So again, we think that valuations may not recover back to pre-pandemic levels. And when we talked about most valuation declines were among REITs that were below 10% during pandemic, and even less for fixed leased assets. So we don't expect the values to recover back to pre-pandemic levels because we talk about fragile growth. So we see the recovery, but it's fragile at this point in time. And that will probably have an impact on the future valuations. Now, having said that, when we talk about indexed fees, fixed lease revenues, that would likely benefit from rising inflation. So basically, our base case is that we expect that flat portfolio evaluations for the sector over the next 24 months. That's the base case, and that's the house view.
Okay. And on a geographical level, do you see some European markets maybe more likely to be challenged? And conversely, which one could see maybe the strongest recovery going forward?
Again, it's not a straightforward question. I think it's a very difficult question because Europe in itself is not one geography. It's a mix of variety of geographies. So I will not be able to tell you. I wish I had that
Mm.
that magic thing which could tell me, or but I don't have that. But what I tell you is that if we look at it in a slightly different way, so for 22, Europe is back on track based on the performances, based on the booking trends that we see, based on the curves, on the booking expectations. The other good news is average daily rates, that is higher than what it was in 2019. So towards, just to give you some stats, so 2019, and compared that to 21 year end Q4,
Hmm.
we had already seen ADRs were up by 8 to 10%
Okay.
compared to 2019. Now 22 is even higher, but this is all because of dynamic pricing, because there's a lot of demand, there's a lot of pent up leisure demand, which I was initially talking about. So we believe that at some point in time, this will gradually go back
Mm.
to 2019 levels, but not exactly to that. We'll still be 8 to 10% higher, but 2022 is much higher. Some of the companies are even saying that they can even include the pricing pressure by up to 20 basis points, so that's quite
Mm.
a lot. But I think the to specifically going back and answering your question, if we look at those players that have more regional presence, because
Mm.
people still would like to think about regional travel, because international travel, if that's going to go up, that will hike up, then those are the soft spots. So those companies that have regional presence, that are closer to home, that are, let's say, not too far away, maybe within the same continent, those are the ones that will be more in the sweet spot. And
Mm.
we've always said it during pandemic and even now, that a lot of holiday homes are the ones that are in the sweet spot within leisure as well. But the ones that are dependent on international travel or international tourists, especially for Europe, that will still be impacted. Now, I'm going to compare this with the US, where the things have picked up at a much faster rate. And if you look at a lot of the ratings, especially, let's say, Hilton, I know you talked about
Mm.
Hilton earlier, there was a lot of pickup of demand, uh, primarily because the group travel has come back, the conferences have come back, the business travel has come back. Whereas when we compare it to Europe, we are still lagging behind. We still had a lot of geographical restrictions, even until Q1 of 22
Mm.
this year, we had restrictions. So for instance, if I compare Accor, which is very European. So if you look at the portfolio mix, it's very European, but then it's also that dependent, some of it is big dependency on international travel. So those things will take time. And I think it goes back to the same question of cost structure. What sort of cost structures do companies have? So perhaps that's a very long answer to your question.
Well, very interesting one as well. That's all the time we have today. But thank you very much for this insight, for taking the time to speak with us today. And thank you all for joining us. See you soon on BiTV.
Thank you.